Hi, everyone. Get started in a few minutes. Okay, everyone, 9:30, time to get started. I first wanted to go over, if you saw my email or the announcement, and learn regarding the rest of our semester. And I did some modification to our original calendar, so we're going to have all the information in one spot now, and we're sticking to it. So, Candace, I'm going to put you on mute. Okay. So we are going to be looking at chapter 12 today, and on Thursday, lecturing that on investments. Please make sure you have your chapter 14's test complete. So by, I think it's the 5th, I think we wanted you to have that done by. I'm going to review the practice problems for chapter 12 on next Tuesday. And then our graded problems, SmartBook and Tableau, will be due by the 13th. Note, we are going to have class next Thursday, which was supposed to be a day off, but we're going to need to keep plowing forward. And also note that our next chapters are a piece of chapter 3 and a piece of chapter 4. And actually, I think I'll probably end up putting a piece of chapter 14 in there as well, on ratios, which is very important for the next part of your project. I did get through the projects that were submitted. I think everybody, all the groups submitted their second part, and I provided some feedback. So if you had any questions on that, just let me know. But that's where we're going to go forward. So our next test will be on 2 chapters, chapter 12, and then this hodgepodge of chapters that we're working on in our next area. Then we're going to do chapter 6 and chapter 18, and that's where we're going to end the semester. I always have high hopes of getting through chapter 19, but for whatever reason, I just can't do it in a normal classroom. So that's where we'll have our final exam on chapters 6. Oh, and pardon me for this. This is an error here. That should be chapter 6 graded problems. Chapter 6 and chapter 18 will be our final exam. That will be on the 13th at 11:59 p.m. That should actually be over this side. I'll have to fix that. And our project will be due by noon of May 14th. Remember, our project is only going to be a paper. So I've extended that original due date on the paper to the following Thursday. You have an extra week to work in your group, get that done, and get it submitted. So I'll be redesigning the rubric over the next couple weeks so that I'm only grading the paper. Are there any questions on the calendar? Okie dokie. Some other updates with the college. I know some of you were in my last class at 8 a.m., but Candace, you weren't, so I want to make sure you are aware of these. They're talking about how we're going to be doing grading, and they're trying to follow the same type of model that other colleges, four-year colleges, are also are doing. Right now, we are to complete grading as we normally would as an instructor, and then it is up to the student on certain courses. Accounting 212, I doubt is going to be included in this list, but they're still defining the list of courses that a student can select, can opt out of getting a letter grade and getting a satisfactory grade if it is a C or higher. But as I said, that's what they're saying to us right now, but it's not in cement yet. They're not saying these classes are being allowed to have that criteria. So more to come on that. Students are also being given the option of, oh, and by the way, it's up to the student to petition the school to change their grade from the letter grade to this S. and you'll have a week after the semester ends, from what I understand. Incompletes are being offered on a certain type of basis if students don't have internet access at all, or they have extreme circumstances such as extreme work obligations. I think everybody's okay in here. Nobody's reached out to me with this kind of issue. And also withdrawals. If you should fail a course, you can opt to have that as a withdrawal. So they're being very lenient with grading, of course, because of this transition. So I just want to make you aware of some of those things. They're also out on the website. So this isn't privied information I only have. This is all out there. Any questions on that? They're also suspending summer registration right now because they're modifying the schedule. They're making it all online. It's all going to be remote. So I know for myself, I don't teach in the classroom during the summer. All of my coursework is remote, but if you have signed up for summer courses in the classroom, you may see them modified to a remote format. They are continuing fall registration. Probably all of you that are here are going to be graduating, so that doesn't really affect you, but just want to make you aware of that. Okay. Anything else before I get started with our work here? Okie dokie, guys. So I'm going to go into our PowerPoint because I'm going to use PowerPoint today because I got to get moving on this. And I know I'm not a PowerPoint teacher, but this is probably the best way to present it because this is just what I would be typing in anyway. So take notes, stop me with questions, make sure you understand the material. We're probably going to get through debt investments today. That's my goal. We'll see. So our chapter centers on investments. We, in this chapter, are the company purchasing investments. So we are the investor. Prior chapters, we saw the corporation selling the investment, like our last chapter, the company selling the bond and the type of journal entries related to the seller. Now we're going to look at what happens when the company buys the investment. So we break our investments down into two major categories when we're the investor: equity and debt. Equity securities are when we as the investor are purchasing the common stock or preferred stock of another company. We're investing in the equity. The debt securities investment are when we're the investor purchasing bonds or notes. And today's lecture will focus on us purchasing debt securities. Now, why do we do it? Well, one is because we want to make money. We might have some extra money in our company that we're trying to earn as much money as possible on them. So what a great way to earn money is to buy debt and earn interest or increase in the market price, or equity and earn dividends or watch that increase in the market, just like any other investor would. We'll talk more about this on Thursday. Maybe we want to make a stronger affiliation with another company. What better way to do that than to buy their stock? Okay. So that's some of the reasoning why a company would go and buy debt or equity securities of another company. Our focus, though, today is when we buy the debt of another company. Why would we do that? What happens when we do that? Well, we know any money that we use to buy this debt investment is going to be paid back to us on a maturity date. We know it's the face amount, so we already know the amount that will be paid back to us as the investor. And we also know we will receive interest payments at certain periods of time. Could be twice a year, once a year. Now, just like we can sell bonds at a discount, well, there's somebody on the other side of that sale. What happens when a company purchases the bonds? And before, I'm not even going to go into discount yet. I'm going to get out of here. I know I said I wasn't going to do anything but PowerPoint, but let me go in and open up a Word document. I could get rid of, oh, look at that. That's my lecture from yesterday. So here's what I'm going to do. Get rid of this because my Accounting 112 class is learning it. So we're going to focus on the investment that it would be the company's buying bonds. So let's set up a scenario. We're company A, purchases $10,000 face value bonds, 6% interest, paid annually, mature in 5 years for $10,000. So company A, that's us, purchases $10,000 face value bonds from whoever, whatever company. The bonds have a 6% interest rate paid annually, and they're going to mature in 5 years. And we buy them for $10,000. So this is the basic bare bones. This is the perfect scenario. We're buying them for their face value. Remember, why did we get to buy them for their face value? Because the market interest rate is at 6%, the same as our bond interest rate. So let's assume this happened on, we're keeping it really simple, 1/1 of 20. So what does that mean? Well, we need to make some journal entries. I just want to see. Okay, just want to see what your author calls everything. I don't have my book. All right. So on 1/1 of 20, company A is going to debit an investment account, an asset account, investment in bonds, let's say, for $10,000. And they always debit the investment account for the principal or face amount. Since they're paying the principal or face amount, they're going to credit cash. So I know we saw this a little bit with our last chapter, but now chapter 12, that's all we're focusing on. What happens when this investor buys the bond? And we start out simple. They're going to buy their bond at face value. Now, what's going to happen for company A each year over the next 5 years? Well, they're going to be paid interest on the bond. So now they're on the receiving end of this interest. So how much are they going to be receiving? Principal or face amount 10,000 times that contract rate of interest of 6%. Since they get it once a year, our time is 1 year. So they're going to be receiving $600 in cash. So each year over the next 5 years, company A will be debiting cash for $600 and crediting interest revenue for $600. Remember, this is revenue to company A. They're the investor. Remember, interest revenue gets reported on the income statement in the other revenue and expense area. So this increases their net income. Then 2020, so it'd be 1, 2, 3, 24, 25. On 1/1 of 25, company A will receive their $10,000 back. So now it's the maturity date of the bond. Now the assumption is that company A didn't sell this bond because bonds can be sold in a bond market, but they kept it the whole time. So on 1/1 of 25, when the bond matures, the company will debit cash for $10,000 and then credit their investment in bonds account for $10,000. So that's a very basic example of what happens when an investor buys a bond. And this is the perfect scenario because they buy their bond at face value, they receive interest over the life of the bond, and then they get their money back at the end. An accountant's dream. Are there any questions on any of those journal entries? Because now, of course, you know we're going to kick it up a notch. Okay, I'm going to stop sharing this and go back to our presentation. So now, like I said, we're going to kick it up a notch. What if instead our investor, now we're going to start using an example here. Let me see if this was the slide I wanted. Oh, that's not what I wanted. There we go. There we go. Okay. What if instead this is kind of the scenario. Okay. We are United Intergroup. We're the investor. This company, Masterware, we saw them in our last chapter, is the one selling bonds with a face value of $700,000, 12% contract rate of interest, dated July 1. So the interest starts accruing on these on July 1, the day the company is selling them. Interest of $42,000 is paid every 6 months, $700,000 times 12% times 1/2, and the bonds mature in 3 years. United Intergroup purchases the entire bond issue when the market interest rate is at 14%. Now we talked about this. Market interest rate is up here, bond interest rate down here. How does Masterware, the company selling the bonds, entice us to buy them? Let us pay less than face value or discount them. Now, just like we did in the last chapter, we, on our side, can also calculate the selling price of the bond. Determine the interest, just like last chapter we looked at. We take the interest on the bond every 6 months for 3 years. So we'll receive 6 interest payments of $42,000. The market interest rate every 6 months would be 14% divided by 2. So to determine the present value, we use the market interest rate for the time period of interest, which would be 7%. So the present value of the interest, $200,195. We're using the ordinary annuity calculation, present value, N is 6, I is 7%. You could use your table, you could use your finance calculator. We're also going to find the present value of that future principal payment of $700,000 using the same N and the same I. But we're going to use a different table, present value of 1. So the present value of the principal, $466,438. So how much will we, United Intergroup, pay for those bonds so that they actually do make a 14% interest rate? $666,633. Now, when the debt is purchased, they will be recorded at their cost. So here's the journal entry we're making over at United, us, the investor. We always debit investment in bonds for the principal, the face value. In this case, we're paying less than $700,000. So we're going to credit cash for the amount of cash we're paying. The difference, we credit to a contra asset account discount on bond investment. For the same reasons, we use the discount account when we're the ones selling the bond. That is interest that we need to recognize as revenue, though, because we're the investor. That's a lump sum interest payment we're going to receive in the future. As of today, we store that interest in our discount on bond investment account, and over the life of the bond, we'll show that as interest revenue using the effective interest method. So on the receiving side, the one buying the bond, we debit an asset account for the principal of the bond, credit a contra asset for the discount portion. Now, what happens December 31st, our first interest receipt? Let me go here. There it is, your favorite thing in the whole world, that amortization table. We're doing the same calculation as we did in Chapter 14. We're taking and trying to determine, first of all, how much cash is the company going to receive? We're the investor here, that's what we're calculating. Cash receipt. It stays the same. 700,000, 12% times 6/12, 42,000 every interest payment period. How much should we show as interest revenue though? Well, take the carrying value of our investment. Again, carrying value will be the face value of our investment, 700,000, minus the balance in our discount on investment. So 666,633 times 7%. We always use the market rate of interest the day our bond was sold to calculate interest revenue. 7% comes from 14% times 6/12. So every 6 months, that's really a 6-month, 7% interest rate. So the company will show interest revenue of $46,664. The difference is the part of the discount that is being removed out of the discount account, because we're recognizing that much of the discount as interest revenue. Remember, the total interest revenue is $46,664. Of that, we're getting $42,000 in cash now. The other part is the part of the discount that we'll receive in the future. So now our discount on bond investment goes from $33,367 down to $28,703. That will cause our bond investment to be $700,000 minus $28,703, or $671,297. So the same way that the company selling the bond calculates the portion of discount that they'll recognize as an expense, the investor does the same thing over at their company to determine how much should be recognized as interest revenue and how much should be taken out of their discount account. So keep in mind these numbers, and I'm going to go back to our previous, there it is. So United, the first interest payment, will debit cash $42,000, debit discount on bond investment, reducing that, credit interest revenue, $46,664, because we're the investor. Are there any questions so far? Going into the second interest payment, which would be 6/30/2022. $42,000 is the amount United will receive. They'll recognize interest revenue based on the new carrying value of the bond at the beginning of the interest period, $671,297, 7%, $46,991. The difference between the cash paid, the cash actually they received, and the amount of interest revenue they are recognizing is how much is coming out of the discount on bond investment. So, and of course it's not there, the next journal entry would be debit cash, $42,000, debit discount on bond investment, $49.91, credit cash, credit interest revenue, sorry, $46,991. And that's how they would proceed each interest payment period. And they would do the same type of calculation if the bond was sold at a premium. Now let me go back here. So let's do that quickly. Let me share. Find my stuff here. Come on. Trying to find you guys. Oh, there you are. Okay, stop sharing. Okay. Coming back over here. Okay. So let's say instead, we'll go back to our $10,000 one here. 1/1 of 20. Company A purchases $10,000 face value bonds, 6% interest, paid annually, mature in 5 years when the market interest rate is 5%. And I'm just going to calculate the selling price of the bond really quick. But you can do that. N is 5. My interest rate is 5 because I use market interest rate for calculating present value. My PMT will be 600 because that's the interest payment. And my future value will be 10,000 because that's the principal that's being paid back. And I'm going to calculate present value. And just to, they sell for $10,433. That's the amount I'm getting. Let me double check that. 5, yeah. Okay, so they sell above face value. Well, what does company A do? On 1/1 of 20, they're going to debit bond investment, or investments in bonds, however you want to, an asset account for the face value. They're going to debit premium on bond investment for the 433, and then they will credit cash for the 10,433. So just like a company buying the bond has to store the discount portion in a discount on bond investment, which would be considered a contra account, when the investor purchases above face value for a premium, they store the premium in a adjunct account for the bond investment. Now, this is a different perspective for the investor because what did they just do? They paid an extra $433 right now to be entitled to a 6% interest rate instead of a 5%. So they're actually prepaying some of the interest they're going to get in the future the day they buy the bond. Because in the end, they're only going to make a 5% interest return over the life of that bond. Now, what happens at the first interest payment date? Well, on December 31st, we need to determine how much to credit interest revenue for. We're the company that's receiving interest. Just like we do for a discount, take the current carrying value of the bond, which is still at $10,433, investment in bonds plus the premium account balance, times the market rate of interest times time. So if I take 10,433 times 0.05, I'm just going to round, I'll put it in this. oops, times 1, because it's 1 year's worth of interest, 521.65. How much interest are we going to receive in cash? $10,000 times 6% times 1. So the difference, $600, is how much we will reduce the premium on bond investment. It'll be the 600 minus 521.65. So I'll show you that in a journal entry. $78. So of that 433 we prepaid, we're going to take $78.35 out of it now, or reduce it. So on December 31st, Company A, the investor, will be debiting cash for $600, crediting the premium on bond investment for $78.35, and then crediting interest revenue for the $521.65. Because remember, over the life of the bond, we're only going to, as the investor, receive 5%. But the company's locked in at paying us 6%. So we're making up the difference by prepaying for that interest rate difference the day we buy the bond. So I just wanted to show you what happens if the investor buys it at a premium. Do you have any questions on that? You would create an amortization schedule just like we did for the discount. And that's basically, I did a quick dirty amortization schedule calculation right here. And that should say investment. You guys know that. Okay, I'm getting OCD. There we go. All right. Questions? All right, then let's, oops, that's not a question, that's an email alert. Okay, so I'm going to stop sharing there, go back to my PowerPoints. That's it, yep. And now you should see the PowerPoint. Okay. So that's what happens when we sell a bond. And we sell it for face. I'm sorry, let me back up. I'm thinking ahead and going on autopilot. That is what happens when we buy a bond as an investment, not sell it, but when we buy a bond and we're the investor. We could buy it at face. So we saw the journal entries, we debit bond investment, credit cash, we get the interest in cash, we're good to go. We could buy it at a discount and realize we still need to amortize discount, each interest payment date, and how we record it. And we could buy it with a premium. Same thing. We need to amortize or reduce our premium each interest payment date using that effective interest method and the journal entries related to it. So no matter what classification a debt investment falls into, you need to do the journal entries related to how you purchase that bond. Beyond that, you must place your bond into one of 3 categories. Now it's up to you, company, what category it goes into. So we would need to be told that in our problems. We have 2 extreme categories and then one in the middle, the catch-all. So the first extreme is actually the second one. That's the first one I'm going to talk about. It's called the trading category. Now, I didn't make these up. These categories were made up 20 years ago in the mid-1990s by the FASB. I was already out of college when they came up with these different categories, and they're standard names we use. Or your author identifies it with the acronym TS, trading securities. Only debt investments are put into these categories. Trading securities are debt investments that we're actively holding to resell quickly, 3 to 6 months if you wanted to put a time period on it. So if you are an investor, you buy a bond, a debt security, and you say, we're going to sell this in a couple months. You would put that security and do the accounting related to that debt security as a trading security. The other extreme is our first one. You buy the debt and you say, we really want to hold this till it matures. And that's our intent. And we can. We have the financial ability to do that. Then you put it in the held to maturity category. So sell really quick, trading. Hold it for the long run till it matures, held to maturity category. For those in between, you're going to hold it more than the near future, but you're not going to hold it to maturity. We have our final category, available for sale. Depending on what category you put that investment in will define how you report it on the balance sheet. When you own that security and you have to make a balance sheet. So we're going to start with trading. This is just an overview slide. We're going to go into the detail of each one. Trading securities, so debt investment bonds, I'm focusing on, that we own at the end of the year in this category must be reported on the balance sheet at their fair value on the balance sheet date. Any difference between fair value and the carrying value of that trading security at the end of the year is reported as income or loss on our income statement. Held to maturity says, nah, just whatever the carrying value is, that's what you report on the balance sheet. Don't worry about fair value. Available for sale category says, oh no, you've got to report a debt security in that category at its fair value on the balance sheet. And any gain or loss because of the difference between the fair value and the carrying value of the bond, oh, you don't report that on the income statement. You report that right in shareholders' equity in comprehensive income. So that's just an overview. Now we're going to look at the details. So, we talked about that. Okay. Let me go through this. Let me see. Oh, they must start. I'll come back to it. Whoa, we don't want that. Let me go to they start with held to maturity. I want to start with trading securities. We'll come back to those other slides. You buy a debt investment, your company, and your company says, we're gonna sell that really quick. We're just gonna hold on to it for a few months, try to get rid of it. So even your author here, I see some authors go up to 6 months. Your author saying you're only gonna hold it for, your intent is to hold it for hours or days. Okay. Investment in debt securities, okay, that are bought for this purpose are put into this trading. Trading securities, so debt in this category, are always listed under current assets. Fair value must be reported on the balance sheet. Any difference between the fair value of the debt security and the company's current carrying value of that investment. Remember what carrying value is. Face amount of the bond plus the premium balance or minus the discount balance. That unrealized, we call that gain or loss. It's unrealized because you don't really have a gain or loss. You didn't sell the bond. You just have a gain or loss because the market value fluctuated. It's like an artificial gain or loss. We call it unrealized then. That's reported right in net income in the other revenue and expense area. Let's see it in action. Masterware bonds, okay, so those Masterware bonds we bought, we're the investor. It doesn't say it here, but we're pretending we're United, the ones who bought the Masterware bonds. They have a fair value of $714,943 at the end of December. Now, where is this $671,297 coming from? Well, let me take you back. Let me find that slide. Remember this? At the end of December, we recorded the interest we received, and we determined the new carrying value of the bond, face value minus the discount, was $671,297. All right. Then we said, oh, well, this bond is considered a trading security. Let me go back. Well, in that case, compare what the current carrying value is. They call it amortized cost, but that's carrying value of our investment is to the fair value. And it looks like it's increased. We don't go messing around with our bond investment account or our discount account to increase the bond value to fair value. Instead, we use another account and either debit or credit that so we could increase or decrease the carrying value of the bond to fair value. So, since we need to increase the bond investment account overall, or the total amount of the bond investment, we will debit a special account that's only used to increase carrying value or decrease it to fair value, called the fair value adjustment account. Sometimes it may act as an adjunct, increasing. Sometimes it may act as a contra, decreasing. So we can't say, oh, this is a contra account or this is an adjunct account. It all depends on what we need it to do. But the balance in that account always will either increase our bond to fair value or decrease it. Remember, and if you take and just need to see a picture of this, make some T accounts. Oh, you know me and my T accounts. Right now, our bond investment account has a $700,000 debit balance. When we bought this bond, and I'll take it back just to remind you, there it is. Investment in bonds, $700,000. You can also make a T account called discount on bond investment, which is a contra account where we stored the original discount, but its balance is right now at $28,703, and it will have a credit balance in it. What we're saying here is now add another account to that mix. So the next account should say fair value adjustment. And we need that to have a $43,646 debit balance. Because when we're on our trial balance, grabbing information for our balance sheet, we're going to go, okay, current assets, bond investment, $700,000. Less the discount on bond investment, $28,703. But if we just reported that, we would be reported $671,297. Oh no, we can't do that. We need to report it at its fair value. So now add, because it's a debit balance, the fair value adjustment account. And that's what that's achieving. Now what's our offset? Gain on investments. And you see it says NI there because we're saying it's going to increase net income. It's going on the income statement. So it's acting. in this category, like we actually did sell it and recognized an income, even though it is unrealized. The impact on net income is to increase it as if it was an actual sale. And the FASB says that's okay for this category. So you'll see this is the major difference. This journal entry right here is the major difference among the categories. Now, what happens when we sell this next year? Wait, assuming that sells the bond for $725 on January 5th. Okay. The first thing we do is readjust the fair value adjustment account to the fair value on the date of sale. So for the trading investment, we go, okay, we're selling it January 5th, 2022. That makes sense. We said we sell it really quick. The fair value adjustment account currently has $43,646 in it. If we had to report this investment January 5th at its fair value, what should be the balance in that account? So we're writing it up or down to its fair value on the date of the sale. And what we're saying here is, well, it should have had $53,703. Well, before we report anything related to the sale, we're first going to increase the fair value adjustment account because it needs to be to have a balance of $53,703. So debit fair value adjustment account, credit gain on investment. This goes right on the income statement. But this gain occurred in 2022 because $43,646 represents the balance as of December 31st. $53,703 represents the balance January 5th, all happening in 2022. Then report the sale. The company sold it for $725,000, the fair value, debit cash $725. Remove the bond, all components of the bond. We're going to first remove the investment in bonds, credited for $700,000. Debit the discount that's still being stored, $28,703. Get rid of that balance by debiting it. Credit the fair value adjustment account so that that doesn't have a balance. It shouldn't. There's no investment. And we remove all of that on the date of the sale. So it's a two-step process when we actually sell it. Write it up or down to its fair value look at the fair value adjustment account and say, okay, what should be the balance in that if I had to report it at its fair value and get it to that point like we did in the prior slide, and then remove the security. Now, of course, there's always another way, right? So that's the beautiful theoretical, let's do it that way. But for expediency, companies may not update the fair value adjustment account to fair value as of the date of the sale. And quite honestly, that would have been my approach. I would have said, oh, I'll just ignore that fair value adjustment account. Who cares if there's a balance in it? I'm not doing a balance sheet. So if we ignore the fair value, if we do this in a one-step process, basically, you get the same result overall. What does that mean? Debit cash for $725,000. That's how much you sold this for. Remove all components of the bond. Debit the discount on bond investment, credit the investment in bonds for $700,000, credit the current balance of fair value adjustment, and then just plug the $10,057. instead of writing up the fair value adjustment account with that first journal entry and then removing it with the second. You could do it all in one step. So it's really up to you. Same result. You still report a gain on your trading securities for 2022 of $10,057. Financial statement presentation. Gains and losses, one more time, are included in the income statement in the period in which the fair value changes, regardless of when they sell them. This does not affect other comprehensive income, meaning the gain or loss from the fair value increasing or decreasing always gets reported directly on the income statement. We always report these investments at fair value in the current asset section. I'm not worried about cash flow. So there's a nice example of our income statement up above. Take a look. Interest revenue from these bonds reported in other income and loss, and there's that gain on investment from the fluctuation in the fair value. Right on that income statement increases net income. Here's the balance sheet presentation. Investments in bonds under current assets, that I'd love for that to say current assets there, reported at its fair value at the end of 2021. So you could see it being reported right on the financial statement. So all of these journal entries are leading us to get to what we need to have on that balance sheet or income statement. Any questions on the trading? I'm going to go to held to maturity then. So that's our first extreme. Sell very, very quickly. Second extreme. I'm going to hold it till it matures. So that's a flow chart of what's happening here. And mainly, it's the first, really the first types of journal entries and information we looked at when we first sold a bond. We don't do anything special beyond that. So if we sell the bond for face value, we report the bond investment at face value. We report interest revenue when we get it. And that's it. Report the bond at face value. If we sell it for a discount, well, we've got to amortize some of that discount into interest revenue. But whatever the bond face value minus the discount balance is, that's what we report on the balance sheet. No special accounting. Same if we sold it at a premium. Take the bond investment account, add the premium on bond investment, and report that on the balance sheet. So there's no special journal entries other than the norm. So the Wall Street Journal indicates that the fair value of the Masterware bonds on December 31st is $714.90.43. How will United account for this increase in fair value? If it's a held to maturity category, nothing. It's ignored. We report it at its current carrying value. Now we'll disclose the fair value in the notes to the financial statements, but how does it impact our income statement or balance sheet? Not at all. Pretty straightforward there. Now what happens when we sell the held to maturity investment? So now they're going to sell it for $725,000. Just something happened. They didn't know. They thought it was going to be held to maturity. Oh, well, we screwed up. Well, it doesn't mean they can't sell it. What will they do? They'll debit cash for the selling price. They'll remove the bond at its current carrying value, which it's January 5th, 2022. So remember, they've already reduced the discount account for that first interest they received. So they're going to credit the investment in bonds for its principal, debit the discount on bond investment for its current balance, and the difference is recorded as a gain on sale. And the entire gain is reported on the day of the sale. Not split up between last year and this year like we do for trading investments. So just like selling any other asset. Selling price minus carrying value gives us gain or loss on the sale. I'm not worried about impairment for this chapter. We're going to keep going. Financial statement presentation. Only realized gains and losses, realized being you sold it and you made a gain or loss on the sale, are reported in the period that it is sold. Unrealized holding gain or losses are just noted in the financial statements. So we don't report them and make journal entries, but we let people know, hey, this investment went up or down. And that's the information about it. When we report this on the balance sheet, remember, if we're holding this till maturity, chances are it's long-term. So you want to make sure you put it in the long-term investment section of your balance sheet at its carrying value, which your author calls amortized costs. We disclose fair values of these only in the notes to the financial statements. So that was your other extreme. So you already know how to report them. Are there any questions on it? Let's see where I'm at with time. Not bad. Anything? All right, then let's look at our last category. Available for sale. They're pretty much like trading securities, how they're reported, but with one major difference. So one more time, trading securities report at their fair value on the balance sheet. Any difference between fair value and carrying value of the investment is reported as a gain or loss on the income statement. Held to maturity, report them at their carrying value on the balance sheet. There is no gain or loss to report until you actually sell it. Available for sale. So you're going to hold it longer than sell it quickly, but you're not going to hold it till it matures. We say this investment is available for sale. It may or may not be sold. These are reported in your balance sheet at fair value, just like trading is. You will also measure an unrealized gain or loss between the carrying value of the bond and its fair value. But that unrealized gain or loss is not reported on the income statement. It's reported as a component of other comprehensive income on that statement. So it kind of bypasses the income statement, never gets reported in net income, and flies right into equity as other comprehensive income. It's just the placement of the unrealized gain or loss. And that's what the FASB has told us to do. So let's take a look. The journal entry is going to look a lot similar. You buy the bond at a discount. You amortize the discount for the first interest payment. That doesn't change. What happens though, if United said, this is going to be an available for sale category investment, we still look and say, what's our carrying value of the bond on December 31st, 2021? $671,297. What's the fair value? $714,943. Okay, so we need to report this investment, even though it's available for sale, on the balance sheet at its fair value, which is above its carrying value. So we need to increase another account, the fair value adjustment account. So available for sale investments will have their own fair value adjustment account that increases or decreases those investments to fair value. Just like with the trading security, we need that account to have a debit balance in it of $43,646 to increase the carrying value of the bond to its fair value. This is a gain, but this gain on investment is not reported on the income statement. You see it says OCI. That means it gets reported on the other comprehensive income area of the comprehensive income statement. And I'll take you back there in a minute so you could see it. So it's considered income, but not for net income purposes. So it increases equity after we report net income as other comprehensive income. Again, what happens when we sell this bond? Well, you could adjust the available for sale investment up to its fair value by doing what we did with the trading investment. If this bond was going to be reported on our balance sheet on January 5th, the day of the sale, what would our fair value adjustment account need to be at? Well, the fair value on January 5th is $725. The carrying value of the bond is still at $671,297. So it would need to have a balance in that to get it up to the fair value of $53,703 to get it from $671,297 to $725. It currently only has a balance of $43,646. So let's increase that. Debit the fair value adjustment account, credit the gain on investment. OCI. Second step. Now, remove all of that. Debit the OCI account, credit the fair value adjustment account. So you're just reversing that entire amount out of there, out of those two accounts that you just increased. Then record the sale and record the entire gain on the sale as income, net income. Now you can report any gain between the carrying value and the fair value only, though, at the date of sale, like held to maturity. So we're not allowed to show income when our investment goes up in value in this type of investment. We can't show gain or even loss on our income statement until we actually sell it. So we're going to debit cash the day of the sale, debit the discount on bond investment, credit investment in bonds, credit gain on investment for the actual gain on the day of the sale. So I don't know about you, but that three-step process is kind of crazy. So let's do a one-step process, shall we? I might have to flip back and forth. Let me go over and stop sharing this and go into my Word so you can see what people normally do on the date of the sale. They're not doing three-step journal entry. Here's what your journal entry is for the available for sale. 1-5-2022. They're going to debit cash, $725. Have to, getting that. We're going to remove the investment. So discount on bond investment will need to be debited for the current balance in it of, sorry, I just need to go back, of $28,703, just like you saw. Bond investment, investment in bonds, whatever that was, will be credited for $700,000. Now my debits and credits are going to be a little squirrely here. I'm going to debit my unrealized gain, OCI, for its current balance, which is the same balance at the end of December, which would have been $43,646. I'm going to credit, to remove that balance, fair value adjustment for its current balance, 43,646. So you can see us writing that up or down at the end of the year in this category has no impact on net income at all. It impacted equity. Then I can record my gain on sale for the full amount. I think it was 53,703. Let me make sure my debits equal credits. So even though that's a little crazy, you can get those 3 journal entries accomplished in one, and it's still correct. So the key here is get the entire bond off the carrying value, get the cash recorded, remove unrealized gain out of the OCI at its whole balance by debiting it and crediting the fair value adjustment account for its whole balance, because you got to remove those 2 accounts, and then recording the actual gain. Sorry if I got a little crazy there, but that's one journal entry you could have done. They just break it down into 3. Are there any questions on that? Okay, I'm going to go back to my PowerPoint. And that's that. Okay. All right. So how do we report these? Again, gains and losses because of fluctuation in fair value at the end of the year are reported right on other comprehensive income. I'm going to pull that up in a second for you. Those amounts are reclassified or taken out of other comprehensive income when the security is actually sold. We saw that. The investments, again, for available for sale security categories are reported at fair value. Now, what you have to be careful of here is if you intend on selling that security in the first year of ownership, because remember, you may think, oh, I'm going to own it for 9 months or 10 months. You would report this category as a current asset. If you're going to hold it beyond a year, then it's in a long-term investment category. Remember, 2 extremes. Trading securities, always current. Held to maturity, usually always long-term. The one in between could be either. So you just have to be careful of that. Any unrealized holding gains and losses become a part of accumulated other comprehensive income and are reclassified out when we remove them when the security is sold. See if there's anything else. And there's a picture, a great presentation on the income statement. They're the only income affecting income statement from this bond, excuse me, in the first year is the interest we actually are allowed to record related to that. Remember the interest revenue that was calculated back on our amortization schedule. The gain due to fluctuation in market price is reported as other comprehensive income after we determine net income to help us achieve comprehensive income. And there it is. So if you're like, comprehensive income, I remember learning something about that. Go back to the chapter where we talked about that statement. The balance sheet, the investment in bonds available for sale, depending on if it's current or long-term, is reported at its fair market value. There is the fluctuation coming in directly into stockholders' equity. So the impact is on accumulated other comprehensive income for the fluctuation in market price. The impact on retained earnings is only for the interest revenue because of net income. It's just coming down and increasing retained earnings. When we sell the bond, the impact from the gain is now recorded on the income statement. Okay, and you could see the remaining items here. So that's how we report available for sale securities. Look at that. Now that's a nice picture, huh? That's everything we just did in a little table. So again, depending on the category of the debt investment will determine how it's reported on the balance sheet at the end of the year. Trading securities are recorded at their fair value. Difference in market value is reported as a gain or loss on the income statement. Held to maturity is reported at its carrying value. Available for sale, they're also reported at their fair value on the balance sheet. Any difference between carrying value and fair market value, that gain or loss, is not reported on the income statement directly, but as other comprehensive income. Don't forget, no matter how you purchase this bond, or what category it's in, I should say, the category doesn't determine if you're going to purchase it for a discount, premium, or face value. Okay, so you're always doing the same journal entries no matter what category it's in, if you bought it at a discount, or you bought it at a premium, or if you bought it at face. The category determines how we account for it on our financial statements, which may cause more journal entries. We're not going to worry too much about transfers between categories, but we want to bring it to your attention that you can. You're not locked in. Okay, so let's say you had something that was originally recorded in a held to maturity or available for sale category, and you changed your mind, you want it to be considered a trading investment. It then tells us how we have to accommodate for that change. What if it was in a trading category and we decide to change it into a held to maturity or available for sale? Tells us how we have to accommodate that change. Held to maturity to available for sale, and available for sale to held to maturity. So all it's telling us here, and we don't have the time to go through it, and at this point in the semester, we just don't. But read up on it. Now, those of you who are transferring to a 4-year, you're going to take this class again probably, so maybe you'll dive deeper into it. And if you are reading through and you have any questions, just let me know. We just want to bring it to your attention that you can do it. You're not locked in. Some more information about disclosing your trading securities, held to maturity securities, and available for sale. So we do, and you'll see this in your financial statements, and you probably already have. In the notes to the financial statements for the companies you're working on, you're going to see they report the total cost of all of the investments in a category, all of the fair values, and there's details showing you how we calculate unrealized holding gains and losses for each category. So you're not guessing. So make sure you take a good look at that while you're working on even going back into part 2. If you were like, I'm not really too sure about that, now you're learning about it. Maybe you want to go back and do some more information on the accounting for the investments. Okay, so I got through it. That's debt investment. Questions? Okay. Well, here's what I'm thinking. We need you guys to be practicing this. So let me grab, I'm not even sure. Just give me 2 seconds to look 1 or 2 things up. And we could see if we can get just working on a problem at least, so that Thursday when we come in, you're not going, oh, I don't remember anything she talked about. And let's see. You're practicing this. So let me take a look. 12, 5, 7, and 13. Let's see, at least one of these will help us. Go into our book. Hopefully I'll get my book in the next week or 2. Okay. Problems. Let's see what 12.5 is. Okay. Problem 12.5 is a great problem for getting us ready for practicing trading investments. And, oh, not that one. Let me see, 12.13, if we could do anything there. No. So how about having problem 12.5 ready? That's practicing bonds as trading investments. And you'll get practice with the other categories in your exercises. And then we can move on after that into talking about the equity securities. And then we'll be able to wrap up chapter 12 by next Tuesday. Okay, any questions at all? Okay, guys, thank you very much. And then I will see you on next Tuesday, or on Thursday, I'm sorry, on Thursday. If you have any questions before then, just email me.